The Bank of Canada just cut rates again, pushing the overnight rate down to 2.5%. This is the lowest we've seen it in years, and everybody's asking, should I take a fixed mortgage or ride out a variable mortgage instead? Today, we're going to break this down in plain English, with no jargon, no hype, just what this actually means for you this fall. Hey everybody, I'm Myles Nowik of the Nowik Mortgage Team, powered by ND Mortgage, and I'm a mortgage broker here in BC. I help Canadians navigate the mortgage market, and my goal is simple: keep you from making costly mistakes and help you build wealth along the way. If you're new here, hit that subscribe button. I try to post videos once per week on mortgages, real estate, and financial well-being without any of the boring banker talk. So what's actually going on here? The Bank of Canada cut the overnight rate down to 2.5%. Why? Because inflation is cooling and the economy is slowing down, which basically translates to they're trying to keep the economy from stalling out completely while giving borrowers a bit of a breathing room break when it comes to mortgage financing. If you're in a variable mortgage, this is good news. Your payments just went down or your interest cost just went down. You'll see this almost immediately. If you're looking at fixed rate mortgages or have a fixed rate mortgage, it's not as impactful. Those are based on the bond market, and the bond yields have been trending down, which means fixed rates should be following. And to be honest with you, a lot of lenders are already starting to sharpen their pencils in regards to this, providing better rate options. Okay, here's the million-dollar question: fixed or variable? Fixed rates give you stability. You know exactly what your payment's going to be for the next 2, 3, 5, 7, or 10 years. And that's great if you like sleeping at night. But here's the catch: if rates keep dropping, you won't be able to benefit from that until your term is up or until you refinance and pay a penalty to get out of your mortgage early. Now, depending on your lender, whether you're with a chartered bank like RBC, Bank of Montreal, or CIBC, your penalty could be quite substantial and absolutely obliterate any interest savings. Now, on the other hand, with variable rate mortgages, they have flexibility, and you benefit right away if rates keep falling. Sounds amazing, right? But there are the risks. If rates tick back up, your payment goes up. Now, keep in mind there's two types of variables. There's a static payment variable and an adjustable rate mortgage. And we'll dive into that in a later video, but for now, let's just accept the fact that if rates go up and you're in a variable, your interest cost or your payment goes up. Plain and simple. Now, with mortgages in Canada, when you qualify for a mortgage, you have to use a stress test interest rate. So let's say we're getting like 4.5%, and that means you have to qualify at 6.5%, meaning you should be able to weather some increases on variable rate mortgages. And I'll explain why I'm talking about this in a minute here. But to be blunt, most people don't actually budget this way. They don't budget by saying, okay, let's pretend our mortgage is an extra $500 a month just in case rates go up. And if you do that, amazing job. You're basically a financial superhero. I mean, seriously, socking away the difference into an emergency fund is one of the smartest moves you can make. But for most people, they're stretched to the max already. And if you're trying to apply for a mortgage and your debt servicing ratios are right at the limit, meaning you can't borrow a single dollar more, then a variable might not be your best friend. Because if rates jump up, you're stuck with that higher payment. There's no way around it. Now, here's a little strategy a lot of people are exploring: shorter term fixed rate mortgages. Instead of locking in for 5 years or more, maybe look at a 2 or 3 year fixed. Why? Because if rates keep trending down, like most economists think they will, you're not trapped at today's rates for half a decade. It's like saying, I want stability, but I still want to be ready for the next move. It's basically the financial version of keeping your options open. Now, the next Bank of Canada meeting is set for October 29th, and there's a bit of a chance we could see another cut. Markets are pricing it in, but hey, the markets have been wrong before. The big risk is if inflation heats up again, or if the global economy throws us yet another curveball. The bottom line, yes, rates are heading down, but the path won't be perfectly smooth. So what's the play here? What's the move? If you want stability and you don't like surprises, or if you're stretching yourself right to that limit, a fixed mortgage might be your best friend, especially on a shorter term. If you're comfortable with some ups and downs and your budget isn't maxed out, variables could still pay off big time if rates continue getting cut the way they have been. At the end of the day, it's all about your risk tolerance and your financial situation. And if you're not sure about this, make sure to book a call with a mortgage broker. And hey, if this video helped out, hit that like button, hit the subscribe button, and tune in for weekly videos that I'm dropping on mortgages, real estate, and how to manage your money with confidence. Thanks so much for watching. I'll see you on the next one.